All right, let's take the conversation forward with Ashish Kehair also joining us. Heads the Edelweiss Wealth Business. Ashish, good afternoon. Thanks so much for your time. I'd like to understand from you this entire issue of surging inflation, not only in India, everywhere in the country, in the world. It is disrupting, everything, almost everybody's daily lives, utility bills, grocery bills, even industrial commodities going up is hurting margins everywhere. Uh, is this one of the key issues which is coming up when you discuss or your team discusses with one of the largest HNI and ultra high net worth individuals across the country who's investing? Is this issue becoming a big issue of discussion everywhere now?
First of all, good afternoon, Ajay. Thank you for having me here, and a very good afternoon to all the viewers. Inflation actually is a problem. It is the number of years where interest rates have been kept extremely low, and it has led to this situation. Plus, the Russia-Ukraine war has added to it. Though it does not directly impact the clients we deal with, right? Fortunately, they are well settled and they have all the means to handle these kind of price hikes, but it obviously has an impact in the businesses in which they are. It has an impact in how flows come into the markets and how their investments behave. So yes, it becomes a part of the dialogue, and it is in fact the dialogue right now is rising yields, rising inflation, and the war situation, or the impact of the war situation. I think these three are the mainstream discussion points right now, and what is the impact these are going to have on the markets on an ongoing basis.
Ashish, how's the investment sentiment among the HNI and UHNI community right now? Are they eager to buy the dips and increase their allocation towards equities, or are they also having a very large portion in debt? How are they kind of opting out for asset allocation right now? What kind of discussions are happening around that?
So opportunistically, whenever market offers some kind of a disproportionate opportunity when there is a downswing, yes, they become keen and interested, but they have an eye on the valuation and the macro. So it's not very hunky dory because we have had 10, 12 years of extremely easy monetary policy, fiscal policy, and so on and so forth. And from a trend perspective, that is going to change. But yes, on the counter side, real economic growth will also come in. So it's a bit mixed. So whenever the market offers opportunity, they enter in. As on the debt side, the challenge is actually higher because when the rates move up, the opportunities after the movement of rates will come in, but during the period when the rates are going up, it's actually very, very painful. So on the debt side, they are looking at things which are slightly non-correlated with the direct MTM impact of rising interest rates. So it could be stuff in which you have real assets and you get yield on it, like commercial real estate or infrastructure real estate or venture debt. So these are actually innovations which have happened in the market, which give opportunities to investors to participate in debt while not getting severely impacted by the rise in interest rates. And I would say real estate after a long gap is coming back, and people are looking at ways and means of entering that asset class, whether direct ownership or through funds, credit funds, or commercial real estate funds. That is becoming mainstream.
Right. Ashish, what are your thoughts on corporate earnings? What is your team telling you about the health of or the quality of earnings? Not on a quarter to quarter basis. We all know that few quarters could come under pressure due to inflation. But the cycle of corporate earnings, if one were to take a 3 to 5 year view, because that's exactly what the portfolio will also mirror, at least the equity part over the 3 to 5 year basis.
So I think you've hit the nail on the head. On a short-term basis, there are risks from the demand side which are not being, I think, fully fleshed out. Actually, that's what the team tells me, that the supply side issues have been fully flagged off and people are cognizant as to how supply disruption can lead to earnings impact. But the demand side impact has not been fully fleshed out, and maybe that is going to play in the next 6 to 12 months. But structurally, from a 3 to 5 year perspective, we remain bullish that the cycle will turn, credit offtake will happen, because again, there have been years and years of almost zero credit offtake. There has been nearly negligible investment cycle from corporates. In fact, when I had gone out and met clients just pre the Ukraine situation, I came back extremely bullish because 9 out of 10 clients were actually using the word capex and investing, which I had not heard in the last 7 8 years, and that was very very heartening. I think there is a kind of a speed breaker that has come in, and once things settle, it will come back. So, in my view, 3 to 5 years, we are extremely bullish from a structural basis. I don't see that going away in a hurry.
Right. How's business, Ashish? You're also, eventually, we're not talking about the transaction, but eventually going ahead, your company will also be on the exchanges. And
Yeah,
others are also, I mean, this entire space representation in the markets is only increasing. And
yeah.
people are also taking this segment as a investable business now. Not only investing in wealth, but also participating into the companies which are in this business. Because I was talking to a very large luxury car retailer, one of the top companies in the country, and they were saying that at least their clientele is increasing 60% YOY in India, whereas their global business is growing 30%. So the number of HNIs in India are growing at a faster clip. Are you capturing that? What kind of observations do you see on ground? Because after all, you work with them, and that will reflect how the business is doing.
I think we are one of the few industries which, on a ironical basis, was extremely blessed during COVID. We saw unprecedented increase in business. I think people just had more time on their hands and they started focusing on their investment portfolios. But on a serious note, the growth in the number of rich people and affluent people, we also operate in a segment which is 1 crore plus, and we are a very large player there. So both in the affluent and in the ultra HNI space, actually there is unprecedented increase in how wealth is coming into the hands of people. And Ajay, the other thing you have to understand, which is happening, and it is the culmination of both. One, the wealth is increasing in the hands of people, and second is the openness of people to look beyond traditional investments. I think when these two come together, you will see an explosive growth which India is actually witnessing. And the third factor is that our industry, although there is so much noise and sound around it, it's really extremely small. There are hardly 10, 12 players, and everybody is just gaining scale. So I think there is a huge runway ahead, and people have only scratched, tier 1 cities, tier 2, tier 3 cities are yet to be tapped into. They are still managed by the traditional, sort of investment avenue providers. We have not gone into that in a big way. You are going to see that happening over the next decade. And yes, we are in the business of capital markets, so there will be volatility. Year on year basis, you could see an up and down, but from a decadal perspective, I think this is a very large structural opportunity.
Let's talk about the alternative space a little more. What kind of options uh, are you discussing with your clients, and how's the offtake over there beyond the traditional investment options? How's business over there?
So I think because the listed markets have seen such rich valuations, the alternative has now started to become mainstream. Because my view is that the catch up of valuation in alternative space, especially in the equity side, takes some more time. So one is your whole private equity or the unlisted asset class, and I think investment managers in the country also, have learned over time. This asset class actually started in early 2000s when people were just learning, and they were not, international funds always did well, but domestic capital was still learning the ropes. Now I think funds are in their series 3, series 4, and they've made money, they've learned from their mistakes, and they've become much more seasoned and mature. And there is a huge amount of client acceptance also, because if you know, AIFs moved into 1 crore ticket size about 10 years back. At that point in time, 1 crore was a really big check, but today it's not so anymore. So one is this whole private equity space which is increasing. Then we operate into a lot of innovative spaces like distressed investing or infrastructure investing. We've seen a huge amount of traction there. Venture debt is coming in. Commercial real estate is one of the best asset classes to give you inflation adjusted returns, but we have not seen too many funds operate in that space, and we are seeing client interest coming back. And this is despite the fact that there was so much talk during COVID that offices will be empty and so on and so forth. But when we went out into the market to assess the opportunity, I think in grade A buildings, it's a golden period. In the next 4 5 years, supply is limited and people will want to expand. You're seeing the expansion in IT side and other many of the other sectors. So I think that will also play out. So overall, I think alternatives have become more mature. Regulatory intervention has made the product more acceptable, and I think client experience has been on the better side. So a combination of these three will lead to a reasonable amount of growth there.
Right. All right, Ashish. Thanks very much for your time dropping by today on the show. Time for a short break. On the other side, some more news and updates and stock specific analysis. Don't go anywhere.